All right, everyone. Thank you for joining us at the BBRG's first time investor webinar. Today, we're going to go over all of the investment strategies that I've learned over the past decade or so, as well as answer any questions that we can come up with. So I will jump right in. I'm going to share my presentation screen and we will get started. Does that come up for you, Jen? Perfect. All right, we're going to jump straight in. So as an overview this afternoon, what we will do is talk about what makes you an investor. And then we will have a stocks versus real estate example, talk about the 1% rule, how you can find rent prices, rent lookup, and then finally we'll jump into a few analysis of rental properties or prospective rental properties, just to go through how you would analyze it from scratch and determine if it was a good rental property for you. Right. All right. So what makes you an investor? The first and foremost thing I can't preach enough actually is you have to have a budget. To me, that sounds almost silly because I would think every person that's an adult in life would need to have a budget, but I meet people every day that have never had one. So let alone an investor. But if you're deciding you're transitioning from just day-to-day life and you're going to be an investor, you need to have a budget. And the second bullet is the reason why. You have to practice profit first or automatic millionaire. These are just two examples of the same principle, but you have to pay yourself first. You have to save money for down payments. And if you're in stocks, you have to save money to invest in stocks. Either way, you need to save money to invest. There's a principle, I can't think of the gentleman's name out there, but there's a principle that says you will always use up what you allocate. So if you make $5,000 a month and you are trying to be an investor, but you don't have a budget, you will spend $5,000 a month. It's almost a guarantee until you start paying yourself first, paying that investment pot first. So create a second checking account, savings account, and auto transfer X amount of money. I'd recommend the 70-10-10-10 strategy. 70% live on, 10% invest, 10% save for a rainy day, 10% tithe if you're religious. Next, have to be willing to hit singles. This is probably one of the number one reasons why I often see people that aspire to be investors don't ever start. They are always looking for the home run. They always are looking just to knock it out of the park, get the best deal that sets them up, is a no-brainer. And the problem with that is the people that are in the game see those first and they take them. They're already made unavailable to the aspiring investor before they ever get a chance to see or know about it, because those aspiring investors are sitting on the bench in the dugout. They're not in the game, so they don't even see what's going on. You have to get out on the field of investing. You have to get into the game, and you have to be willing just to take singles, single, and then because you're in the game, you will run into a home run every once in a while, and that's a great feeling, obviously. But you got to get in the game. The last bullet here is consistency and practice. We're going to do some analysis, and I was kind of warming up and looking over the map, a couple areas that I might touch on later in the presentation. But what I realized even after making this presentation and after doing some of the analysis to prepare for the presentation, I realized how much of the city of Indianapolis I'm familiar with compared to 2007 when I was trying to find my first rental property and I had no clue what I was doing. I had no clue what the prices in neighborhoods were. I had no clue what rental prices were. I had no clue what areas you would even start to look at to be able to invest in. And now it comes second nature, just like breathing. So you have to do it. You have to sit down in the evening after everything's said and done, instead of maybe watching a Netflix show, go through, do some analysis like I'll show you tonight. And the more you do it, the better you get, just like riding a bike or learn to ride a bike. Pretty soon it'll come second nature to you. All right, let's keep going. So on this slide, talk about stocks versus real estate. So everyone most likely has heard of stocks, probably understands stocks, probably knows you can start a E-Trade account or Fidelity or something and put some money in the stock market. And a lot of people probably tinkered with it, if not are day investors. You know, a wide range of skill set in my sphere and people I talk to regularly, from the beginner all the way to almost like a day trader. So here's a little breakdown of how I see stocks versus real estate. And obviously I'm biased, but you signed up for this, so you probably knew that coming in. More passive stocks. So you can buy a stock and put your money in the market and just sit there and wait and never do anything. You can buy dividend stocks. There's a lot of stories about Warren Buffett buying Coca-Cola and Apple, etc. These stocks, not only will they grow and appreciate over time for how much they're worth, but they will set out dividends to the stockholder sometimes multiple times a year, where you're getting paid because you own the stock. That is great passive income. All right. Less control. I put that here because personally, I don't know any specific CEOs. I guess I may know a couple, but of stocks that I'd be interested in purchasing, I don't know, Mark Zuckerberg. I don't know Jeff Bezos personally. I don't know the Apple CEO. I don't know these people. I don't know. I'm not in the boardroom. I don't know what their company decisions are. So I can't have basically any control other than signing on to the annual shareholder meeting and voting on what they have to vote on with my share control. But you have basically no control over a Fortune 500 type stock. You're just assuming that the people in leadership are doing their jobs well and they're going to make you money. So that's why I put less control. Lastly, more volatile. In a day in the market, and especially today, back in the 70s, 80s, 90s, I can't speak to that. I wasn't a trader back then, but today I look at the stocks and it feels like every little bit of news hits the market and immediately stocks are up and down, and one day they're down 5% and the next day they're up 7%. It just feels like the stock market overreacts all the time. I don't think it used to be that way, but it feels like it's that way now. And then you also have computer algorithm trades set up now. So you have auto trades happening all the time where an average person like me or you could set up buys and sells and not even log in to the stock market that day, but I may buy or sell 10 different trades that day just because I've set up the auto algorithms. So these things can go up and down and sideways a lot faster than they used to be able to, and therefore more volatile. All right, and with real estate side, I'm looking over at that other side, they're less passive. The reason, unless you have property management, which we can talk about in the Q&A session, unless you have full property management, totally hands off, just send me the check every month, you're probably going to be a little bit more involved in the day-to-day as far as like if a tenant needs something, just the upkeep and maintenance of a home, you're going to have more hands-on. So they're less passive, a little bit more work. More control though. And I put local versus out of state because if it's out of state, you truly are probably passive. You truly are, with a property manager, and you probably don't. It's probably just like a stock. However, if you're local, which is how most people start, you're probably in control of that. You can drive over and see something if it breaks and decide, do I want to try to fix this or do I want to hire someone to fix it? You have more control of the situation day to day. Lastly, less volatile. Just the nature of real estate, you can't liquidate it very fast, typically 30 days if you're buying and selling a home. So it's the decisions and the market do not react to the news quite as quickly. It takes months of news cycles to cause a depreciation of that asset and an appreciation of the asset. So now I put depending on the location here because California, New York, cities in Texas, Denver, Colorado, those are areas known to be a little bit more volatile. Arizona, Andrew's on here, get a little shout out. But the Phoenix market is a little bit more volatile than, say, the Indianapolis market. All right, but overall, it's definitely less volatile than stocks. All right, and then you probably had a chance to look while I've been talking. I just did an example of just monetarily what you could do with $100,000 over time in both stocks and real estate. And I know that if my friend, Mr. Drew, I won't call his last name out, but if he was looking at this, he might argue with me, but I'll give the stats of what's going on in here. So obviously the stock side is pretty straightforward. 100,000 in, 10% each year, you get those numbers. Those are very straightforward numbers. Those don't include dividends because you'd have to tell me what stock you're doing, and we'd have to know the dividend rate and all that stuff. So that's just a very basic, straightforward example. Now, real estate, the reason the numbers grow faster in this example, primarily, you see the little graphic over there to the bottom right, is leverage. In real estate, you can easily leverage money. In the stock market, you can also buy on leverage. I don't recommend it. That's a whole nother class and another recording for that. But for the most part, most people don't buy on leverage in the stock market. In real estate, it is extremely common to buy on leverage. So my example is two purchases, two $250,000 houses with 20% down, which is $50,000, which gets you a $250,000 house for $50,000. That's 20% down. So you have two $250,000 houses appreciating over time while your tenants pay down that mortgage. And that spread is what's shown here in this slide from year 1 to year 20. And you can see that because of the leverage, you only have to put $20,000 down to take advantage of an appreciation of a $250,000 asset. And then you can double it, since the examples with $100,000 for both. So I'm getting double the appreciation, I'm getting double the mortgage pay down, and I've only put down the same amount, which is $100,000 total for those two home assets. And that's how the numbers work out. Now, you can throw a lot more numbers into this. For example, I didn't account for property management. If you look at year 1, it's about 10% of the rent, $24,000 rent. It'd be about $2,400. So I could take off $2,400 if I want it to be completely passive and take that off. I wouldn't make that much, but I would still make more than in the stock market, and have it be more passive with property management. This doesn't take into account capital problems with real estate. So my HVAC system could go out year 1 and that would take down that $24,000 number because I'd have to pay for a new HVAC. However, over time, you could see that even with some of those things, those expenses that we're discussing, it's probably still going to outperform the stocks. And that's my personal belief. We could run numbers all day until we're exhausted, but I prefer real estate over stocks. Now, I have both, and I recommend having a diversified portfolio if you're investing. But I will always have more real estate than I will stocks for this reason. Let's move on. All right, so the 1% rule. This is just the easiest rule I've ever learned about investing in real estate. So you're driving around, you see a property, you think that might be a good property. You might be browsing your realtor's MLS search because you're definitely not using Zillow if you know a realtor. And the property is listed for $200,000. How do I know if it's a good rental property prospect? The easiest, quickest way is 200,000 times 1% is 2,000, which means that the rent for that property needs to be around $2,000 a month for all the other background numbers to add up. So we'll do in the analysis here in a little bit, we'll go into those background numbers and deep dive, but you probably don't want to be on your laptop as you're driving through town, stopping in traffic to type in all the numbers to see what it works. So if you want to just do a drive-by and see if you think it would be worth digging into when you get back to your computer desk at home, then this is the rule of thumb. All right, and I marked there a note. Since COVID, it's been going down as an accepted ratio, so 0.85%, and we'll see as I've kind of done a look at the market, I'm seeing 0.65 to 0.75 in the neighborhoods I would normally mark as good rental neighborhoods. So it's low right now, but as you also see, it's a lot to do with the lagging rents. You've probably read articles or heard the news that rent prices are raising, and this is part of the reason why. They haven't kept up with the appreciation in home prices over the last 4 or 5 years, And so rents are going to continue to go up. That's a nature of this formula, as well as just supply and demand forces. So good rule of thumb, but just know it's really hard to find a 1% property these days. And I hope that we get back to that as soon as possible for my investing purposes. But it is still a good rule of thumb driving around traffic. All right, you might say, well, how do I know how much the property would rent for? Well, that's a great question. Again, ask your realtor. We have MLS access, and that's the first place I go as a realtor to look up rent prices, but that's only accessible if you know a realtor. So, by the way, they're more than happy to help you with this. Most people think that investments somehow are different and realtors don't want to talk to people about investments. Couldn't be further from the truth. Your realtor's there to handle all your real estate needs. So definitely go to them and say you're interested in investing and you'd like to discuss what that looks like with them and ask them for rent prices in areas that you're looking at. Another website that I use is Rentometer. It has a subscription. So I talked about if you're in IT, which most of my sphere is, you can use a VPN or incognito mode and it gets around them wanting you to pay every time you do a lookup. But you can put in an address and kind of a rough beds, baths, and it'll come back and give you a quick analysis of what that area looks like for rent prices. Biggerpockets.com is my go-to. I've had an account on there for probably 16 years, I feel like. But it is also a paid subscription, which I'll show you today. I actually need to resubscribe. I haven't re-upped apparently, but I have like 5. You get free reports. I think you get like 10 free reports before they make you pay. So have a couple freebies. We'll use them tonight. And then lastly, rentals estimate. Zillow does have a rental estimate on it as well. So that's always a good place. Zillow in general is known to be inaccurate in a lot of ways. I find it also to be inaccurate with rental prices, but it's at least a ballpark if you're just driving through and wanting to see if you should do more analysis on it. All right, well, that takes us to what we'll spend the majority of the time on tonight, which is the analysis. So I'll switch screens here and we'll jump into some of these tools that we were talking about. And at any point in time, if you have questions, we can do that ad hoc real time and we'll go through any of those questions to look at the analysis of these properties. All right, here we go. Switching out here. I'm gonna have to stop sharing and start sharing because I shared a tab instead of my screen. 1 second. All right, here's an MLS. Welcome to being a realtor day to day. I also have another tab here on the screen. The mortgagecalculator.org is a great tool. And then we're going to jump into Bigger Pockets here to do some of this analysis. But I just wanted to show you those starting out. Let's jump back into the MLS. And this is the Indianapolis market. I'm going to zoom out to give you a perspective of where we're at. So this is the map of Indianapolis. The only thing I have as far as searches go is just residential, single family, for sale or for rent, and active. So we will jump into a few neighborhoods and I will tell you and show you what I do whenever I'm trying to decide whether I like rental property. All right. So I know one along 32 in Westfield is kind of known to be a rental neighborhood. And as I zoom in here, this is Sanibel. And as I zoom into this neighborhood, you can see some available properties. You got ones for sale at $423,350, $285,000, and then for rent at $1,975. So just taught you one of the principles. If we're driving through this neighborhood and we saw these things available, I could quickly just pull up my calculator on my phone and say 1975 divided by purchase price of 285 is going to be about a 0.69%. So that's about where this neighborhood's setting right now with no other work. got about 30 seconds of work to evaluate whether this is a good neighborhood to buy rental properties. Now that is really lazy as far as analysis goes, but it gives you an idea of what you might start doing just on a day-to-day basis. All right, let's dig a little bit deeper than that and see what's going on in this neighborhood. So this rental property right here is for rent. It's 3 beds, 2 baths, 1,872 square feet in Westfield. I even might flip on the pictures. Looks like they've photoshopped the grass there. I want to see the quality of this house inside. Pretty decent laminate flooring, decent paint job, maybe a little dated with the wood, not bad though. You know, decent construction, probably a great rental. A little bit extra. You really don't need backsplash tile for rental properties. I can tell this countertop is the Formica countertop, which is perfectly fine for rental. I would think that if you had quartz or granite, it'd be too much. Spent too much money on that. So I'm flipping through, just looking for defects. How old is the carpet? Am I going to have to replace it as an investor? Looks like they upgraded the bathrooms a little bit here. Did some tile shower work, probably not necessary for a rental property. But all in all, this is a pretty nice property, pretty good prospect for a rental. All right, it's a big yard too. That's nice. All right, so that rental is going for $19.75. So another ratio you might look at is square feet to rental price. So it's about $1 per square foot on the rental price. That's another telltale sign as far as what can I expect to get. Now say I'm interested now. So there's obviously a rental property in this neighborhood. They do very well in this neighborhood. I'm aware of this neighborhood. And I may say, well, I may want to buy this one over here then and rent it out. So the first thing I want to look at is, all right, if I'm going to, well, we already did the ratio. It's about 0.7%. So it's a little low. I'd like this price to be a little cheaper or to be able to get more rent. But do you think I can get the same or more rent if this one's 1,800 square feet and this one's only 1,200 square feet? Most likely, I'm not going to get $19.75 for rent. I'm probably looking at $1,700, $1,600, something like that. $1,200 is too low. You're going to get more rent than that. It doesn't go on a perfect correlative curve, but you'll get the general same rent in the neighborhood. But you're probably looking at $1,500 to $1,700, depending on quality. So would I want to buy this house for rental? It's got a newer roof. I can explain that in another seminar, but it's a good roof. Flooring's not as good. That other one had laminate flooring. This is carpet throughout, it looks like, and it's kind of oldish carpet. It's matted down a little bit, so it's probably going to need replaced. All right, you got the kind of textured popcorn ceilings. Same Formica countertops. Older counters aren't as appealing, not updated in the bathroom. So this house overall isn't as quality as the rental, but it's not bad either. It's clean. It's neatly kept. So not a bad purchase. A little small for my taste. I don't feel like I could come in at $285 for this house. To make this work, let's jump into an analysis. All right, let's take 18080 Sanibel Circle. I'm going to flip over, and on biggerpockets.com, if you make an account, you'll get your account set up, and you'll always have a tool section up here. There's a lot. We can do 102, 103 sessions and maybe 201 sessions for more rental webinars to get deep into all these different variations of investing. But today we're just doing a basic rental property. All right, we're going to start a new report. I'm not going to worry about adding photos. I don't need to do this. Just for my own sake, I'm going to do this 18. Oh, I'm going to have to flip back and forth. Let's see if I can do it quickly. 18080. 18080 Sanibel, and it does have a lookup, so it's going to find it, which is nice. It found Noblesville. Technically, it's right on the border of Noblesville and Westfield. We'll just go with whatever it found. Purchase price. We'll just do what it says right now, although I can tell you it's not going to work. And that's just lots of practice, like I said in that one slide. Purchase closing costs. The greatest part about this tool for any new beginner is these help bubbles over here. If I hover over the help, or I guess this will actually take, here we go. So typically closing costs are 1 to 2%. That's a fairly, this is a national website, so you kind of have to, you may have to adjust it based on your local, but we'll just do 2,850 since it's about 1%. That's pretty accurate for this area. All right, I don't really need to rehab it, but if I thought I did, I mean, I may put in carpet here, but that's probably not worth it. I guess I could do carpet repair costs and get a quote for carpet, but again, let's just do this quickly tonight to get through them, and you can always start using the tool in more depth going on. So again, down payment. Now you're going to have a hard time finding a general bank like a Chase Bank, a Huntington here in Indianapolis. And I don't know what banks are out with Andrew, probably Wells Fargo in the West Coast, but you're going to have a hard time finding a bank that is going to do an investment loan without at least 20% down. They may exist. If you wanted one, I would go to community banks because they loan their own money, not the government's money. All right, so 20% down, that's the 57,000. Interest rates are very interesting right now. They're supposed to be going down soon, but right now we'll say 7.2 is where I was quoted a loan for an interest or investment property recently. Again, that changes daily. That's pretty volatile actually for daily, so always check with your lender, which I can refer you on if you are interested. Points charged, that's for a 102 class. We're not going to do that today. 30 years, it's my opinion as an investor, you always want this to be as long as possible. And the reason why is because properties appreciate, our incomes appreciate, our rents appreciate. The thing that makes a rental so valuable is the payment, your expense stays flat. So the longer you can have it stay flat while everything else in the equation is appreciating over time, the more money you make on that spread. All right. So some people say, well, I don't want to, I want to retire in 15 years. Well, then pay it off in 15 years if you want to do that. But for investment purposes, it's pretty smart to get the rate as low as possible for as long as possible. All right. We're going to flip to the next one here. Let's, for this exercise, just pretend that we could get the 1975. I mean, that's a reference point. So let's just use it. Again, this is where I would use some tools to figure out. You can actually click this link right here, and it's got its own rental analysis calculator that'll open up, as well as you can go to Rental Meter, Zillow, etc., and find other references. But we have a reference from the MLS saying that in that neighborhood they got 1975. Let's keep going. Property taxes in Indiana are going to be 1% of the purchase price, but when it's not your primary house, it's going to actually be 2%. So we have to calculate 2850 times 2, which is 5,700 a year. That stinks, but that's just the nature of investments. Insurance, I'm going to put about 2,000 a year. Repairs and maintenance. Now you can get quotes on this stuff. You can go look this up. You can get quotes on this. So I'm just doing this because I kind of know the area. If you're really serious about buying, you need to go through the steps of actually doing these things. All right, repairs and maintenance. When I first started using this site, I clicked on this every single time. Now, Hamilton County, where I live and where we're doing this analysis, has very low vacancy, and typically, and you kind of have to judge the repairs and maintenance. This house is in decent maintenance. So I tend to want to try to make these things work. So I go on the lower end. If you want to be super conservative, I mean, 15% is egregiously conservative. So you could pick 10 and that would be fair. But if I can get this to work, I'm good with using the lower end numbers. So vacancy literally in Hamilton County is 0. Like maybe 2 weeks out of 52 weeks, whatever that percentage is, just to get it turned over, but it's going to get rented again. Your area may be different, so use whatever number you think is appropriate. All right, capital expenditures, again, 5 to 15%. So I'll throw in 5. That's your roof, that's your HVAC. So this calculator, the best part about this is it is factoring in what you're going to need over the course of all time, right? It's not saying let's wait until HVAC goes out and then figure out how to get $5,000. It's saying, no, we'll start saving $98 a month immediately out of the rent, and we'll decide if this rent will cover the the necessary expenses, right? So it's the smart way to do things. Here's the management. When you start out, I would say Indianapolis is 10%, almost by the book. It's very rare that you'll get a different quote. But when I started out, I did zero and I did it myself. And I used YouTube and I fixed everything. I fixed everything in a house. I'd probably recommend starting that way to make a property work for you. But if you're like 55, 60 and you're trying to retire, you probably don't want to manage properties and fix them. So I wouldn't, at that point, I'd run the numbers with 10%. So let's do 5 just for the heck of it. All right, we're not paying bills. Different markets around the country have different kind of cultures, what the renters expect to have to pay. In Indianapolis, the renter pays everything, literally every bill. We don't pay anything. Sometimes the landlord or owner will pay the HOA fees just because it's kind of weird to charge that back, but I've seen it charged as well. So I usually leave those all done. So let's go look and see whether this is a good rental. All right. Well, I can tell you right here that it's not. If you want to bleed $568 a month on your rental, then this one's for you, but it's not got cash flow based on all these numbers that we just did. All right, so let's dive into a couple different numbers. So the mortgage payment's $1,547. So depending on how risk averse you are in the game of being an investor, you can decide if you want to take this on, because if we truly could get the $1,900 a month and only pay 15 out of a mortgage payment, then we're going to have enough money to actually make this work as an investment. Because remember, in my slide, the biggest 2 reasons you make money are appreciation, which you do by owning the house, and then mortgage pay down, which you do by having the rent come in and pay for the mortgage. So everything else kind of comes out in the wash, and you can get really nitty gritty on doing the numbers. But this might work if you just care about those top level numbers. Let's talk about why it probably wouldn't work though long term, because long term these expenses are real. And I love this site because I can play with it and see what I need to get it to make it work, right? So for example, I said Hamilton County as next to 0. So then I slide that over and boom, my number goes down. So I'm closer. All right. Purchase price. So I told you from the outset this wasn't going to work because I've done these numbers enough and I can just visually look at it. But let's say I really wanted to and I wanted to make an offer on this house. How low would I have to go to as an offer price to make this work? So if I take it back to 275 and I'm only offering 275 to this guy, I don't know if it's gonna, we'll do that. That's 450 a month. So now we're closer. Maybe instead of 20% down, I put 25% down. Now we're closer. So all these levers matter. Obviously, I cranked out loan terms. And here's the biggest one that the whole country hates right now, right? We all hate our interest rates. We got used to 2.5%, 3% interest rates, and everybody could buy every house, except the problem with that is it caused huge amounts of inflation. So we want the interest rate to go down. And I just got off a webinar from my real estate mentor in the business, and he said by 2025 we should expect it to go back down to 4.5%. All right, so let's decide if we could offer this guy 265,000, because I think it's going to set on the market at 285, and we just keep talking to him and say, hey, 265, we'll get this deal done. All right, now I'm down to 314. All right, that makes sense. Say I want to manage myself, because that's probably what you need to do to start out in this business. Now I'm down to 216. All right, say I could do this now for 2 years until I got a refinance at 4.5%. Let's see when I refinance this property. Now, actually, I probably shouldn't take it to 4.5 because as an investor, second properties are, the banks always charge more interest than first. So let's actually do it at 5 and see what happens. Now I'm cash flowing. So I've just used this analysis tool and my knowledge of rental income to work this down to the point of I could make an offer. I'd put 25% down. I would get it for 265. I'd just keep offering that until they either found a buyer, pay them more, or they decide to go with me. And then what I'm counting on, and this is, we can have another webinar again on the future of interest rates, but my most trusted resource in real estate told me the rates were going to go down to 4.5 by 2025. So if I buy this now and take advantage of the low price, because I guarantee you in 2025, when the interest rates are 5%, I'll be fighting 25 people for this property, and the price ain't going to be 265. It's going to be 285 to 300 because people bid it up. They'll be in the market against me. But right now, this market, it's going to set on the market because of that interest rate being 7.2, and people can't make these numbers work. But if you know what I know, and you know that if you buy a property now and you can somehow survive, again, remember, we always had enough rent at this rent rate. That's another question we have to solve for, to cover the mortgage. So we're always going to be good. It's really going to be these odd expenses that could come up if the roof leaks, if the HVAC goes bad, that we have to decide, do we have a comfortable enough income and lifestyle to cover that in the next 2 years? If you do, then you can make this property work, because you'll get the property refinanced and then you'll be cash flowing. All right. And now cash flow is a whole nother question and another attribute. Some people I know as investors in Indianapolis will not do a deal unless they cash flow $100 a door. That's their bare minimum. For me personally, I look at those figures that I showed you earlier in this presentation, and to take advantage of getting the appreciation of the property and the mortgage paid down by a renter paying my mortgage for me, I don't need any money cash flow. My life's not substantially going to be better because I'm getting $66 a month or $100 a month from rent. It's just not going to. I just need to cover these expenses and have it be flat, because at that point, it's just a little money printing machine sitting in my wealth building portfolio that's appreciating, and my loan that I owe the bank is going down at the same time. And if you love the game Monopoly, which my family does, we play it all the time, you know that if it works one time with one house, and everybody that's jumping on here probably owns a house and or has owned a house, if you believe that your wealth is building by owning a house because you're paying down the mortgage and it's going up in value over time, the process of investing is just multiplying that like a Monopoly board and owning 10 houses. And it's happening 10 times simultaneously instead of the one time in the house that you live in. Plus, the house you live in, you're paying the mortgage payment, and the other 10 ones that we're talking about, someone else is. So this is just a process of multiplication once you understand the principles of these numbers. So you just repeat it, rinse and repeat. All right, let's look at a couple things. So let's put this, we'll keep most of this the same. I like most of it. So let's come down here and kind of look at this chart breaks down the expenses. Our mortgage, once we refinance in a couple of years, is going to be here. I mean, we can look at it 7.2 as well. It doesn't really matter. It's easy to do. All right, mortgage is $1,353. Taxes, insurance. Now your mortgage payment is probably actually made up of all three of these. So it's going to be all those combined. The variable expenses are your capital expenses to repair things, and your maintenance, etc. Here they're listed out right here. So you can see your total expenses and how that all breaks down. Let's talk about some of these numbers. So net operating income. So at the rent rate that we picked above, it's netting you $13,638 a year. All right. This number, or this acronym, is called cash on cash return on investment. So what it's calculating is you put down, your loan amount was $200,000 and this was $265,000. So you need roughly that much with your closing cost. This is your cash. So what is your investment netting you for a return on investment year over year? Well, it's netting you negative numbers right now because this doesn't work. But if we go down and pay less on the mortgage, it goes into a cash on cash return. of that. All right. Your pro forma cap and your purchase cap, you can read about all these different things. So cap rate is a quick metric that you get used to in real estate in Indianapolis. It's between 8 and 10%. And that's what can you expect if I paid all cash for this house, how much money would I make on my money? All right. It's similar to cash on cash return, just nuanced differences. All right. So I suggest reading through all this, getting used to it. Here's here's another rule that we didn't put in the presentation. So I talked about the 1% rule. Another rule is called the 50% rule. And this is in this calculator. I love this. So if you know your total monthly income or rent price, essentially, you can usually guesstimate that it's going to be about $987. Half of the rent will probably go to expenses every month. All right. So this is just looking at my monthly principal and interest on my loan is going to be, how's it line up with that 50% rule? A lot of times you'd like your mortgage to be about 50% of your total rent, because then the other 50% will get you cover your capital expenditures, vacancy, bills, expenses, etc. All right, so that's the 50% rule. It's a quick and easy way. I love this graph, and this graph kind of mirrors what I showed earlier in this presentation with all the numbers, but it shows you how it's a double whammy in real estate. This is why real estate beats out stocks again, in my opinion, most of the time, because you got the property value going up and you have the mortgage balance going down. So you like, here's the hard times where people don't understand real estate. They're like, I'm not really getting anything. I'm not really getting anything year 1 through 5. Whereas they're seeing their stock market investment going up this 5 years, and they're like, this is better. Stocks are better. Well, that's short-sighted. That's only 5 years, because as it gets closer and your payments get more, driving down your loan payment or your loan balance every month, and your property value appreciates because it's a compounding interest equation as well, then you get the double whammy spread in the later half, and that's where your gains are humongous. All right. Up front, your cash flow is not making a lot of money. It doesn't feel like you're doing anything. It feels like you just got a headache because you got to go, fix something at the rental once a month or something. And it's like, why did I ever do this? Well, these numbers at the back end are why you do it. This is a long-term strategy. Buy and hold is what this strategy is called, because you're supposed to buy it and hold it and not expect to make a lot of money. But if you can, I have a rental property that I've designated for each one of my kids. That rental property, by the time they graduate high school and get into college, will literally pay for their college. I'll be able to either sell it, liquidate it, and pay for all their college, or better yet, I'll not owe anything on it, and I will just take the cash flow, which will be the mortgage. There won't be a mortgage, so I'll just take the entire rent check and pay their tuition each semester with that, never having to pay for college. So that's the type of things you want to set yourself up for long term. This isn't a flip game. A flipping game is another job. It takes full time. Flipping is literally a full-time job. So it's not quick cash. How do I make money really fast? That's another job, and I can teach you that in another seminar. All right, let's do one more. I'll do it quicker because we're almost to the end of time. Let's just jump around the city a little bit. I know another neighborhood that I've always liked every time I go over to it. It's in it's called Saxony Village here. This is Hamilton Town Center. This is just outside of Noblesville, kind of the newer age Noblesville, if you will. It's off 69. There's lots of shopping and eating and everything there, which is always a good indication of good rental properties, because people that rent are usually, this is debatable, I guess, but your best and most likely renters are going to be before they're home owners, right? You may get renters that are elderly because they're downsizing. I wouldn't count on those renters. The renter age is going to be out of college before they start a family, and that's just the bread and butter typically. So it's not like you can't rent to someone else, but when I'm looking for places to rent, I look for what's around, because renters are going to want to be around the action, out to eat, out to get a drink, out to do entertainment. All right. Saxony Village is a great spot. It has been for many years. Here again, let's just do these numbers. I'm already seeing a better ratio, right? You can probably pick that out yourself. Let's do, where's my calculator? 2,200. The last one was 0.7%. So 2,200 divided by our cheapest one in here is 284, 500. Almost a percent better, or a hundredth of a percent better. It's almost up to 0.8, 0.77. All right, so that's better. So if I'm sitting here as an investor, now for me, that other one was a lot closer to my house, so you have to factor in time and driving, and you want to drive further to your renter. If you have property management, that doesn't matter. But this one's further away from my house, so I might take that into consideration. But overall, monetarily, out of the gate, better option, right? So let's look at the everything really quickly again. I'm going to speed up this last part. 13270 Heroic Way in Fishers, 3 beds, 2 baths, 2,900 square feet. That's a lot of square feet, which is probably driving up that rent price. All right, you might have people sharing the bedrooms. Again, laminate hardwood floors, same as the last rental. Everything looks fairly up to date. That paint color is not exactly in anymore, at least not in Indianapolis, maybe in the desert out there. More browns are favorable, but good cabinets, good kitchen, granite countertops, a little bit excessive for a rental. Huge upstairs loft, bath, worn down carpet. You can see the carpet's matted on the stairs. All right, flipping through, everything looks good. This is the one for rent, I believe. So this is our comparison on the lake. Got a fence though, keep the animals and kids safe. All right, over to the one that we may buy by comparison. Let's see, 3 beds, 2 baths, 1,700 square feet, still a good size rental property. Not as much as the 29. I mean, that's 1,200. That's almost a house smaller. So I don't know that you can get the same as this other neighborhood. I don't know if we can get the 2,200 rent price for this one, but we're just going to use that as an example right now. All right, this is more of what's called a shotgun style house based on the shape of it. But let's jump in and see. These floors are actually a little bit nicer, I think, than the last ones. These, I think, are vinyl plank instead of laminate. Cabinets are good. Vinyl plank upstairs, not updated, but not terribly dated. There's your layout. Pretty good here, pretty good here. Plenty of space, even though it's a lot smaller. Yeah, it's a lot smaller because it doesn't have that humongous loft upstairs like the other one. Appliances look good. It's also got granite countertops. Kind of crazy for rentals, but hey, no one's going to complain about nicer things. Got a small loft upstairs. And so this would be a fine rental. There's nothing sticking out like that. I believe this would rent fine in this area. Vinyl product, shotgun style, garage in the back, the concrete. If you're buying this property for yourself, I would probably want to get a concession for that. But you know, it's going to be a rental. The renters probably won't care, probably won't prevent a renter from renting it. All right, 13350 All American Road. Let's go do our analysis. All right, let's go back to tools, rental property calculator, start a new report. And guess what? I already forgot it. 13350 All American Road. That's what happens when you're old. All American Road. There she is. All right. It's importing the data, which is nice for square footage, property tax, etc. All right. Purchase price. Let's get into it. 284.5. Again, we have the sliders, so we don't have to worry much about that. Let's just do again 1%. So 2850. This is almost the exact same numbers before, except we're going to put in a better rent rate, so that may help. Next, loan details. We'll do 20. We'll do 25 since we know we'll probably have to make it work. We'll start at 7.2 again. Probably won't stay there. 30 years. You can start to see how this, you'll get good at this quick because a lot of it's the same. So if we're doing 2,200, which again is a stretch because it's a much smaller property, we got to double this, unfortunately. 34. Let's just do 3,500 for rounding. 2,000 a year typically to do that. We'll do 3. Was it? No, I'll do 5%, I think, right? Yeah, 5. want to do 0 because, again, Hamilton County gets rented immediately. Going to do 5 here. We're going to do 0 here because we're starting out and we got to make numbers work. And apparently HOA is $13 a month. All right. Hitting the analysis. Are we cash flowing? Boom. This one's cash flowing out of the gate because of that higher rent rate. $61. So this is not bad. 10% annualized return on my money. That's right in line with the stock market. And everything else is looking good. So we did a couple of these things. So actually, this one's working with a 7.2% interest rate, and I did have to do the 25% down because I knew I was going to have to make it work somehow. So you need more money down to make this work. Interest rate, though, check this out. When I get in 2 years, whenever I refinance this property, my returns go skyrocket. I'm making $364 a month, and that's above and beyond saving for these expenses. My maintenance and CapEx expense are already being taken out and put into a side savings account every month. So I'm good on HVAC and roof if I need it. But you know, I'm making another $300 some, and that is a great example of how you can just put that rent right back into the account. And then what happens is it starts to snowball, and then boom, you got a down payment for your next rental after so many couple of years. So net operating income, $18,000 a year roughly on rent. So in a couple of years, say 3 years, you can rinse and repeat, right? Because what's our down? Yeah, we need $60,000, $70,000 in this market to buy another rental. So 3 years go by, I'm taking my money, I'm sticking it towards another rental, and then it adds up. So instead of 3 years, now I got 2 rentals going at the same time, and you cut that 3 years down to a year and a half, and then another year and a half. Now you have 2 rentals supplying the down payment for the next one, and it's going to be cut. You buy another rental, and it's going to be cut down even further. So you can see why when this process starts, it's a little slow out of the gate. But if you do it the right way, it starts snowballing, and all of a sudden you're shopping for a rental, it feels like, every month. And pretty soon you got enough money when you start adding the rentals up to where this number starts to pay your monthly bills, and all of a sudden you're like, I don't know if I need to go to work today. All right. So that is the rental game. We're 5 minutes out. I want to stop and see if anyone has any questions. If not, we'll probably end a little bit early, but these are some great tools, great reports, great analysis that we've done tonight. And if you have any further questions above and beyond this, please feel free to reach out. My phone number is always in my email signature. So you can send us an email, a text, or a phone call. We'll be happy to work through any of this with you. If you're interested in becoming an investor for the first time. But remember, get in the game, hit singles. You'll get a home run eventually if you're in the game. All right. Andrew, I saw you come off mute. Did you have a question?
No, just say great job. Say a lot of great information, and say we did a couple screenshots as we were going through to take a look at some of the tools that you use.
Absolutely. If you have any questions in the future, just reach out. Definitely walk through them with you again one-on-one.
Oh, that was good. Thank you.
Awesome. Well, I know we're going to be sending this out to a lot of people. A lot of people couldn't make the time slot, which we might change next time. But I'm going to send out the recording, and I hope you guys enjoy it and appreciate it. And if you're interested, we have one coming up next week. Same time, Jen?
Next week is going to be Thursday evening, 7 p.m.
Thursday at 7. Join us for first time home buyer webinar. And the funny part about it is, if you strip away all the terminology of investing, buying a home for your first time, a lot of the reasons apply as to it being why you should be an investor. It's the same reasons why you should become a first time home buyer. So we'll get into those details as we get there next Thursday. But join us if you can. If you're watching this after the fact, either join yourself for the first time home buyer, or if you know someone that's on the fence about home buying, please have them join as well or watch the recording. All right, everyone, have a great evening. I'll see you next time.
Thank you.